Okay, welcome back. Jonathan Garner is now joining us. He's Chief of Asia and Emerging Markets Equity Strategist at Morgan Stanley. He's joining us from the sidelines of the Morgan Stanley conference, which is being held here in Mumbai. Jonathan, great to have you back on the program, back on the channel. Thank you for your time. Prashant, this side. We were just sort of, before we came to you, we were looking at those sort of news lines which were coming through, that the GST Council is already starting to look at rationalizing tax rates on various things. I mean, I'm assuming the big talking point, of course, at the conference is the new government and the shape and form of things that we will see in terms of policy. Yes. If you can sort of reflect on some of the conversations you've had, and what are people sort of coming to you in terms of questions and even answers with regards to India and the market trajectory?
Well, I think the key thing to emphasise is continuity. So we have continuity in the finance ministry and in other ministries. Obviously, some changes, but I haven't looked at the details of what you're just referring to. But the aggregate fiscal stance has been a key, underpinning of India's performance. Relatively contained fiscal deficits, reorienting spending towards capital expenditure and away from subsidy expenditure. Containing the size of the civil service and these sorts of measures. And that's something that investors are looking to see continued under the new government.
Right, Jonathan, good to see you in. Just wanted to know, one of the things, thesis that Morgan Stanley has is that going forward, the earnings will actually grow 500 basis points above consensus. The street is factoring around 15 to 16%. You guys believe that for the next 4 years, India's earnings could grow by almost 20%. And that would be the highest ever rate of growth for India's earnings in any period of history that you look at. What do you think will bring this alpha as against what consensus is expecting?
Well, it's really to do with the building blocks. So at the macroeconomic level, we've got a GDP growth environment that has been surprising on the upside, as you know, so 7 to 8% real GDP growth. Probably the aggregate sort of inflation rate, let's say around 5%. So that gets you straight away to sort of a 12, 13% nominal GDP growth environment. And then when we have corporates that have business models that are geared to the parts of the economy that are probably growing more rapidly overall than that, so consumer discretionary, industrials, financials, a sector like real estate, for example, that's starting to become much larger, it's quite realistic to think that you can get a 20% EPS CAGR. And in fact, India is already delivering. If you actually look at the last 3-4 years, we've actually had dollar earnings per share growth in India that's about 60 percentage points faster than overall emerging markets. So it's a complete breakout in earnings performance by India already.
Jonathan, hi, good afternoon. Great to have you on the show. So, question on foreign participation in Indian markets and what you hear around you. Foreign investors have been quite conspicuous by their absence, really. They've been buying Indian bonds, but not so much Indian stocks. One explanation that we got was that the US market itself is doing so well, so it's more about buying home equities. The other talk about is always about China, whether there's some more money flowing there. But what in your sense is leading to this underperformance, purely in terms of flows? And do you see that changing in the second half for India?
In a word, yes, but I think it's worth spending some time to sort of disaggregate the flows a little bit, because I think there's often some sort of confusion about what's going on, and this year has been quite an interesting one in that regard. So traditionally, when you talk about flows vis-a-vis India, you're often really been talking about FII flows as that subcomponent that is from active emerging market fund managers. Now, that universe, the dedicated EM fund universe, is not really growing. There's significant changes happening within it, so India's actual relative share in that index is going up whilst China's declining. But what you are seeing now happening is a shift of global investor portfolios towards Japan, towards semiconductors, in particular AI-related names. And so that has, in a sense, absorbed a lot of the new money flows this year. And of course, we've had the election, so there's been uncertainty about the direction of India. Now we have the election and we know what the result is. And so I think actually not only are we likely to see some stabilization from the more traditional EM side of things, but what's really important is that as India's outperformed for 3-4 years now, its share of global equities is up to almost 2 percentage points, 200 basis points in the benchmark. When it was just 50 basis points 5 or 10 years ago, it was within the tracking error of most truly global fund managers. So they could afford effectively not to own an Indian stock. But that's not the case anymore. And if we're right about this earnings growth, the first question you asked me, and the future development of the market, it's going to be a $6-7 trillion market quite soon. Truly global funds, which are far larger than traditional EM funds, will have to buy the first 1, 2, or 3 India stocks. And it's at that point, I think, that you're really going to start to see the FII flows picking up. And if you are that kind of global fund and you're thinking, gosh, I really need to come to India, I need to buy my first stock, then again, the election it doesn't happen every day, obviously every 5 years. That then is also a reason to now come to conferences like ours and to think about buying India.
Jonathan, are they really, very large global funds who don't have any exposure in India at all, who will be buying, as you said, their first stock in India?
Yes. Yes, yes, there is. Yes, absolutely. We've done some analysis on it. I think, again, I'll be limited in what I can say about stocks, but if you look at a stock like ICICI Bank or other mega cap stocks that operate, let's say, as sort of diversified conglomerates across India, those are candidate stocks. When China was in its heyday, which it's definitely not right now, you did have leading China internet and e-commerce names, particularly those names that actually IPO'd in the US, that found their way into a wide range of global equity portfolios. But that story is now over, effectively, and India's standing ready to move into that sort of position. So I think it's a really important change that's happening in global investor portfolios in the non-Japan part of Asia. Japan has always been essentially a more central part of global equity portfolios. But India has not actually reached out really beyond dedicated EM funds until this point.
Yeah, no, got that. How are some of the foreigners looking at the huge amount of participation from retail and what that is basically meant for valuations? Because,
Yes.
dips are very short-lived now. You see the
Yes.
election volatility, right? Nothing. So it doesn't give you an opportunity. It just snaps right back. And we've consistently moved higher without very much help from
Yes.
foreigners. So, yeah, go on.
Yes, and I'm very aware that small and mid-cap stocks have outperformed large-cap stocks, and things like private sector banks have not done as well as some public sector entities here. But by the way, we don't just recommend ICICI Bank. We have names like Gale, we have Godrej in real estate, Maruti Suzuki. These are names that essentially we are allowed to talk about because we're actively recommending them at the moment. But we don't actually have a lot of small and mid caps, and the global investors will obviously have issues around liquidity and indeed on valuations. It's essentially something we see many times when a country is as successful as India is now, and when the demographic is relatively young, that people embrace their stock market, often in a very big way. They're making their first investment. They may be buying their first property, they're taking on their first mortgage. And sometimes that can run out of hand and has done historically in certain geographies. Now, it's not my job, in essence, to sort of call time on that, but it's certainly something that my colleague Ridham Desai is very focused on.
Just to complete that point, Jonathan, but is that the risk for India then? If you're trading at 19 times forward earnings only on local money and you're saying second half expect the foreigners to come in as well, then is there enough stock to go around, or could this be a melt-up sort of a situation, which may be the biggest risk in itself?
The kind of stocks that we think, foreign investors will be interested in have actually been the stocks that have lagged the markets. And if you look at what Ridham or I have been writing about, we've been writing about mega cap India as inherently, let's say, cheaper valuations. That's the heart of our earnings growth story. But when you say at risk, this really only matters if there's an awful lot of leverage that is underpinning these investments. And, we don't actually think that that's the case. If you say, look at China, which we haven't talked that much in this interview yet, but essentially they built up an enormous property bubble with very large amounts of debt in their economy underpinning that property bubble. In fact, total leverage in China is more than twice that of India if you look at debt to GDP, and then household leverage is 3 times that of China. There doesn't seem to us, albeit you can get volatility in small and mid-cap stocks in India, that there's anything like that story of enormous build-up of debt and capital misallocation that happened in China.
So if the foreign funds do come by in the second half of this year, as everyone's anticipating, then you would presume that a lot of it would go to private sector financials, which haven't done well, in this up move that we've seen so far.
Yes, and obviously some of those names that I mentioned and some of the mega cap diversified conglomerates that exist within the Indian market. I think what people will be probably less interested in buying are the offshore earner stocks, including some of the IT outsourcing names, because there, again, the AI thematic, we get asked a lot about what that means for those business models longer term. Near term, they're guiding quite strongly on earnings, but longer term, these AI tools in terms of coding and a lot of what these companies provide, it might actually be quite disruptive for them. So for us, the India story is very much about domestic India, domestic demand.
Jonathan, will you guys be sort of initiating more and more names every year? I mean, because there's hunger for ideas, right? I mean, I think we hear from domestic investors all the time.
Yes, I mean, we're very strongly of the view that India and Japan have these two secular bull markets, so we've been rolling out additional coverage in those. And Asian investing is far more diverse in terms of the opportunity set than it was 3 or 4 years ago when the conversation was overwhelmingly China-centric.
Just a quick final point from my end, Jonathan. Here's this market where a lot of the industrial stocks, capital goods manufacturers, and many of them are MNCs, they're trading at 80 times, 90 times forward earnings, whereas you have consumer stocks, which have traditionally been more expensive, they've come down to about 50 times aggregate. So just,
yes.
Overall, in terms of portfolio stance, would you still continue to favor economy-facing stocks in India?
Well, I don't know if you count Maruti Suzuki as a consumer stock, but it's certainly, you're right, it's interesting. The relative performance trends have been quite significant, and it has thrown up some of these sort of valuation disparities. And I do think that the consumer is going to be an important part of the economic story here. It often goes this way, that when you have, let's say, a regime that is fiscally stable, where you've got this infrastructure delivery I mentioned at the start of the interview, the consumer can then use a lot of this infrastructure. And again, the inward FDI that we're getting in the manufacturing sector, which is unprecedented at this point, that creates jobs that pay higher wages, again, that speaks to the consumer. So, yes, I think it's right to be tilted towards that.
Right, Jonathan, thank you so much for joining in with your insights on what looks good in India, what the risks could be. Obviously, I was, glancing through some of those risks, which included the likes of long-term effects of artificial intelligence, geopolitical tensions, and perhaps something like climate change as well. But those are conversations for another occasion and a much longer chat that we'll have on all these risks. But for now, wish you good luck at the conference, and we hope that, foreign money does come in, as you mentioned, in the second half of this year. But more importantly, earnings should grow 20% plus as well. Take a short break, come back as always. We'll get you what the dealing rooms are talking about on this weekly options expiry day.